Well, good morning, everyone. Thank you, Deborah, for the wonderful introduction. Again, my name is PamJ, and I'm a partner with Lewis Jacobson and Vet Law. And I guarantee I'm not going to be as exciting as all we've done this morning. So, if you want a cup of coffee, that's great. If you see your neighbor starting to nod off, just give them a little nudge, ready to fall out of the chairs. So in your packets on your chairs, you should have received a brochure here. This is just going to be like a guideline, some of the items we'll talk about, some of the tax forms that you're going to need. And then at various points during the discussion, I'm going to stop and you can ask me questions. And then, if we don't have time at the end, please, you've got my information. If you just want me to, answer a question that we haven't touched upon, give me a call, shoot me an email. I'd be happy to help anybody who has an additional question. Okay, so congratulations to all of you. You're self-employed individuals. And so what we're going to discuss is now the not so fun part is how do you do your taxes. Okay, and so in the most basic terms, your responsibilities are to report your income and expenses on Schedule C. And you can find, if you want to look at the brochure, Schedule C is on pages 3 and 4. And that's what the form looks like that your self-employment income is going to go on. So the IRS does not stipulate that there's any method in which you need to keep your records. So you can determine what works best for you. You can keep them on a sheet of paper, you can use an Excel spreadsheet, you can use Ticket, you can use QuickBooks, whatever works for you. The key point is that whatever you're reporting on your Schedule C, you need to be able to substantiate to the IRS. So that being said, you don't need to have a bank account, but if you wanted to open a separate bank account, that's one idea that might help you capture all of your income and expenses in one part. You can get a debit card and use that for any purchases that you might have. Again, it's not mandatory, but something that you might just want to think about as your income starts to grow. So the first thing we're going to discuss is income. Now, you might have several types of income from Mary Kay because you're going to have your commissions, you're going to have prizes, you might have been awarded a vehicle, and you're going to have your product sales. So, Mary Kay, by law, will need to issue you a Form 1099 miscellaneous, technical form number, if you have income over $600. And as such, you'll see that amount reported on the form, and there'll be a detailed sheet behind it that's going to tell you about each of all those categories that you earn the income in. So that part of it, as your record keeping, is easy. It's already done for you. The harder part is you have to keep track of your product sales. So one suggestion that you might use to keep track of product sales is there's an Excel spreadsheet here, just an example on page 5, of something that you might want to use. You can put your income in by month. So for the product sales, what you want to remember is that when you purchase your product from Mary Kay, you pay sales tax on the retail value of your product. So when you collect those sales taxes from your customers, it's not income to you. It's a reimbursement of a sales tax that you have already paid for. So on your Excel spreadsheet or whatever sheet you want to use, you might just want to make that distinction very clear so that you're making sure that you're not claiming it as income. And then, again, you can keep track of it by month. That's my recommendation, to have some method that you're always kind of capturing that income so that you're not trying to do a lot at the end of the year. It just makes it a little bit easier. And you also get to track where you are in your own performance. Okay. So any questions right now about income or where it's reported on this, Deborah?
I would just clarify that the income reported from the company is based on team member commissions only.
Okay.
Just because we got a lot of new consultants in the room, so that's just the only time that Mary Kay would report a commission to the government is over 600 in team commission only.
Okay, thank you for the clarification.
Not personal sales.
Okay, good. Okay, so next we're going to start talking about the expenses. For the most part, anything that you have associated with your business is going to be 100% deductible. There are certain expenses that get special treatment, and we'll talk about each of those. But what's an expense for an IRS? The IRS defines an expense for business as something being ordinary and necessary. So it's really a very broad category, so to speak, of what's necessary and ordinary. You could have an item like, let's say the first line item on that Excel spreadsheet is advertising. So advertising could encompass a lot of different things. It could be your business cards, it could be a flyer that you've done, a purchase of a church bulletin advertisement, whatever it may be. And you can summarize all of those, and you're gonna have one expense line item then at the end of the year that's going to be considered advertising. There's certain expenses, and again, so the types of expenses you can have is you're gonna have class supplies, you're gonna have bank service charges, you're gonna have many different types of storage containers, all of those kinds of things that you have associated with your daily business. And there's actually a tally sheet in the pages here on 6 and 7. This is a wonderful sheet, and it indicates a lot of items that you can use as references to what's expenses. What are your typical Mary Kay expenses? So a couple items, as I said, the IRS segregates because they get separate treatment. One of them, the first one we'll talk about, is meals and entertainment. So meals and entertainment is only 50% deductible by law. So you may have a meals and entertainment in a different fashion. So let's say you attend a conference, you're out of town. Because you're out of town, away from your home, you get to deduct your meals and entertainment. You may have a meeting with another director or someone else at a Starbucks. So again, that would be another meals and entertainment. You may pay for beverages at an event, something like that. So all of those are considered meals and entertainment. Now, if you have a meeting with someone, say at a Starbucks, the IRS would ask that you keep records of who you met. So you have your receipt, it has the date on it, turn the receipt over, write the person's name, and you might just make a note. Talked about this event or networking or something like that. That's all you need to do. So it's not that arduous. Take that, stick it in your purse, and you're set. One of the other items that gets special treatment is we have to look at cell phones and internet. Okay? I mean, unless anybody has a cell phone here that they use 100% just for Mary Kay, then of course that's 100% write-off. But that's generally not the case. We all use our cell phones. We're all personal, it's all business. So what do we do in those situations? Really what we need to do then is we need to make a segregation. How much is business? How much is personal? And the same is with the internet. How much are we using for our Mary Kay, when we're online, emailing clients, all that kind of thing? And how much is our personal and how much is our family using? And you just need to do your best at making a proration determination of how much is allocated to each. IRS has become far more lenient on cell phones. If you're not saying, oh, I use it 100%, they're generally going to say you're making the allocation. It's a fair representation. Okay, any questions on any of those three items?
Should you break out tips?
For meals and entertainment? No. The entire amount is considered the expense.
Okay.
Is there a red flag amount for these cell and internet, or how do you determine what you should be reporting? Is it like 10%, 20%? Is that a red flag? 50% red flag?
I don't know that there's necessarily a particular percentage that would be a red flag. But again, if you're saying I use it 97% for business, that might be a little bit of a stretch because an IRS agent's going to look at it for reasonableness. If this is your only business, you might be using your cell phone a lot for your business, and maybe 80% is not unreasonable. But if it's a situation where you definitely know you use it for other purposes, then you should try and make the best proration that you can.
Is there a guide like per minute of cell phone use or per minute or hour of internet use? Like there's for mileage?
There's really not. And the IRS used to make people actually come up with their phone records of, but no one gets those records anymore. You don't get the line item anymore. So, and they found that, they weren't gonna really go after people for, trying to look at line items on cell phones. So there's more of a reasonableness. You just have to be looking at it from an outside perspective. Really, what is that 2%?
When you're talking about reporting for your vehicle, or you've got Medicaid, you're driving around, you're exposing that, how does that tie in regards to anything that you feel important vehicle for the purpose of
paid for that, that's an advertising expense.
Just
Can you
for what?
repeat the
Yeah, we-
question, because it's a fan
Oh, so sorry. So the question was, is what if you have some kind of, advertisement on the side of your vehicle, does that count? And the answer would be yes. Who's paid for that? That's advertising.
But just the cost of that
Yes.
sticker, I'm talking about the vehicle in and of itself
Oh.
being.
Mobile advertising. Absolutely. We're gonna touch base on vehicles next, or either next or the one after. Next
Sorry.
No problem. Okay. Yep.
When you're with internet and the cell phone, say you have a bundle, so your internet, your TV, all that's included, how do you, I mean, is it based on just what your, the part of the bill is considered the internet? I mean, how would you?
Yeah, I mean, usually if you get your bill, it's gonna give you those 3 bundle items, so you're really only looking at the internet, not the television portion, or if you have a landline.
Okay.
Okay. All right, and then, just as a big side note on receipts, you should keep your receipts for 3 years. The IRS can go back and audit 3 years, so you wanna maintain those, in case you need to have proof of your schedule C. Okay, so the next item we will talk about is gonna be the automobile expenses. And on page 8 of the handout, I've just given you some reference items, for those vehicles. The IRS has 2 methods that you can use for your vehicle. The first method is the standard method, and in the standard method, the IRS is going to say, whatever miles you drive for business purposes, you're gonna be allowed X amount per mile. So the amount for 2015 is 57.5 cents per mile. So whichever method you use, the key here is you need to know 2 things. One, what is the total miles that were driven on my vehicle for the year? You take your odometer reading at the beginning of the year, at the end of the year, easy, you're done. The other part that you're gonna need to keep track of is what are my miles for business purposes? And I suggest that you get one of those, 50-cent notebooks, and you stick it in your car, and you jot down when you go somewhere, the date, how many miles you drove, and what your purpose of the driving was for. That is what the IRS would ask you for, a log of some type of the miles that you have driven. Okay, so the first method I talked about, 57.5 cents is the amount for 2015. So we just take the total number of miles, multiply it times that amount, and that gets reported on our Schedule C. So that's a fairly simple method. The other method is a little bit more cumbersome. This one is called the actual method. And in this method, you need to keep track of all of your receipts. So we're talking gas purchases, oil, repairs, insurance, car washes. And what we do in that particular deduction is we'll add up all of those expenses, and then you're gonna take a proration. My business miles were 1,000, I drove 10,000 miles for the year. I have a 10% business use, you're gonna multiply that times your actual expenses, and that's what you're gonna get as a deduction. Now, when you have a vehicle, you can really choose between either of those methods. And you can actually flip between the years, but it's a little bit more, there's some limitations in doing that sometimes, but you can actually choose either method. If Mary Kay has given you a vehicle, that is gonna be reported to you on that 1099 as well. And then you're gonna report your expenses against the income that you're being allocated for your vehicle. Yes?
What about making, if you have car payments and insurance, can you claim that for the actual method as well?
You can't claim the car payments, you can claim the interest on those car payments, and insurance, yes, car insurance is included.
What would be the benefit between each of these? Like why would you choose one over the other?
And today, with gas prices being as low as they are, my recommendation is you do the standard method. It's most likely gonna be better for you. 57.5 cents per mile is pretty generous. Last year it was 56, so IRS increased it because it was what, $4 a gallon last year?
Yeah.
Now we're at 2. So to me, it's gonna most likely probably go down in 2016 if gas prices stay the same. So I think really, in my opinion, you'll be much better off in using that method.
What if we didn't track the total miles per year? Like, I don't know what it was January 1st, 2024.
If you haven't really done that, I would go back and just try and make a best guess at the beginning of the year
Can I
and then track it
suggest-
at the end.
What I've done in the past.
Can we
is
repeat the question for the tape?
I'm so sorry, yes. The question was, is what if you haven't already recorded your odometer at the beginning of the year?
So what I've done in years past, because that's what I'm really bad at, is tracking, but I'm really good at writing stuff in my planner. Like when I'm doing something, I go back in my planner and say, okay, I went here, then you can go to Google really quick and then just write down in your planner.
Great, an excellent idea.
Also, your mileage might be on, if you have any work done on your car, you could actually look up the mileage.
Right, and so the question here is that you might have some work done and usually write down the odometer, and that's an excellent idea, and that was one of the things that I was going to suggest that you save, even if you're on the standard mile method, save those receipts from the Jiffy Lube or the car repairs, because they are gonna put your odometer reading on that, and that also helps us substantiate to the IRS that this is true. An outside source is verifying my odometer reading. So that's very, very helpful. Okay, go ahead.
Did you say if I buy a new car, part of the taxes is a write-off?
No. The interest, if you have a car loan payment, if you use the actual method, the interest could be a possible write-off as one of those expenses that are combined. So you could do that. Now depreciation is also allowed on the actual method. And I'm not gonna go into the calculation because that's somewhat cumbersome. It depends on the type of vehicle and all of that kind of thing. But that is another item that you could possibly deduct. Okay, we're good with that? Okay. So the next item we're gonna discuss is home office. And on your handouts, you'll see that on page 9, there's gonna be a home office deduction page. And again, the IRS has given us 2 options on home office. And the first one is called the simplified method. So the simplified method is a lot like the vehicle per mile method. The simplified method is gonna allow us to take $5 per square foot, all of your home office, up to $1,500 as a deduction. So what do we need to do in this situation? You need to first determine how much square footage is used for Mary Kay. So you determine that, and then we're gonna compare it also to the total square footage in your home. So what constitutes square footage? You can have a desk area, you can have a storage closet. Doesn't necessarily mean you have to have a whole room in your home dedicated to Mary Kay. You can have half of a room. Whatever the square footage is that is used is allowed as a deduction. Now, it must be regularly used as your home office. So can you claim your entire family room? No. But if you have something an area that's specifically for Mary Kay, a desk or whatever it may be, you can claim that. So you want to make sure that you go ahead and calculate the square footage of that. The other qualification is it must be your principal place of business, which for all of you it is, because you're self-employed individuals and you work out of your home. Okay, so now we talk about the simplified method. The other is the actual. So again, same kind of idea like the automobile. You're going to keep track of all of your expenses. So the expenses that you'll have are going to be your utilities, gas, water, electric. You're going to have your homeowner's insurance. If you don't own a home, it's going to be your rent. If you do own a home, you can possibly take your mortgage interest and your real estate taxes. So we're going to total all of those expenses, and we're going to take that same type of proration. How many square feet is my Mary Kay portion? How many square feet in my total home? You're going to take that percentage and multiply it times your expenses for the home office, and that's what you get to take as a deduction. So in your packet, you'll see that there's just a little example of what's the simplified, what's the standard method, and then on the next couple pages, there are some worksheets to help you calculate and what's used as far as the expenses are on there as well. So it gives you a really good idea of what type of things to look for. Okay, any questions on home office? Okay.
If, like in my house, I have part of my bedroom as like where my desk and my storage is. But when I have people for classes, I'm using my dining room table and that area as well as my family room for like the closings and all that. Is that, how would you calculate that?
Okay, so the question is that you have a regular place that you normally use in your bedroom and have part of your bedroom, and then you sometimes have meetings where you have people come over. The meetings are not regular, so that wouldn't qualify. The desk in your bedroom would. Okay. they've had multiple places that they use for their home office. So what you need to do in that case is from January through, say, June, if that was your home office, you claim that percentage, and then you take the rest of the percentage for the rest of the year. So it's gonna be like a mix of both.
So if I'm a new consultant and I purchase like a new desk and a chair, is that considered expenses for my business?
Yeah, so the answer is if you purchase a desk and a chair, is that an expense for your business? And the answer is yes. If you use that just for Mary Kay, that is an expense to your business.
I have a family printer, but I use it a lot for Mary Kay and color prints. So how do you, is it like a cell phone where you just allocate a percentage?
Right, so we have a printer, and we use some of it for home and some of it for Mary Kay. So yes, if you're using it for some personal, take an allocation as best you can with that.
But, and then as far as like when I'm buying ink, I shouldn't buy it on my Mary Kay card. Like on a Mary Kay business card. If I'm primarily using it for Mary Kay, but how would you, is it kind of like buying like doing the standard versus the actual?
A little bit. I mean, if you're primarily using that only for Mary Kay and your personal is such a minimal amount, then I think that you're okay in claiming that as a Mary Kay card.
So just buy it with my Mary Kay company card?
Yes.
Okay.
Okay, one more.
What constitutes you were saying regular use, like my dining room is primarily used for Mary Kay, but I do use it for family purposes from time to time, but mostly it's designated for, appointments and such. So how do I determine whether that is regular use or not?
Well, the technical rules are regularly and exclusively. So really want to try and make it an area that we just use for Mary Kay. I mean, again, not to say someone sits at your desk, it's no longer available. It's not going to be that particular, but it has to be something that we can kind of support.
Wow.
Like if we held appointments the same night of the week, like I hold my appointments Monday nights, Thursdays, and Saturday afternoons.
But you're going to use whatever that is. Like say you're meeting in your kitchen. So the question is we're using it on regular nights, but you're not using it every day. And that's your kitchen table. It's not exclusive.
So like if I built an addition onto my house.
Yeah, there you go.
That'll save you money.
No, I really
way to save you money.
I'm not being
There's
serious.
a large system built in that no one can customize.
No, I really want to build an addition on my house, so like on the bottom, I could use like a little studio. I'm being serious.
Lisa Blackmore
Yeah.
did her pink bubble, and she took it all off, didn't she, on her taxes? Lisa
Yeah, I
Blackmore
mean,
did that.
right, you would have to you would get a proration perhaps of that, but yeah, if you're using it exclusively for it, then you would be fine.
Okay.
Okay, so now we're gonna look at, cost of goods sold. So we talked about a lot of other expenses. How do you determine the cost of what you're selling? So the IRS has a formula, and actually, this is gonna be back on your TLE sheet. It's gonna be on the first page of, on the top of page 6. So the IRS says that you take your beginning inventory, you add the purchases that you've made, which is gonna be your section 1. You make an adjustment for anything that you use personal of your cosmetic supply, and then you subtract out your ending inventory. So you should take an ending inventory at the end of each year. All of this is at wholesale, not retail, but wholesale. That calculation should give you what your cost of goods sold amount is. Now, just remember section 1, inventory, and then, if you have section 2, supplies, that's an immediate write-off. Your inventory can only be expensed as you sell it, so it's not an immediate expense when you buy it. It's only when you sell the product. Okay, questions? Yep.
So where do, like, the products we take for demos, does that go with our, like, in the same category as our personal cosmetic use, or?
No, because what will happen is when you use a demo item, so the question was is what happens with demo items that we take out? That will actually be calculated in there to come to your cost of goods sold, because your inventory, when you count it, will have one less item. So it'll come out as an expense.
Okay.
Now, the personal items, that's just for what you're using for your own personal use.
Expiration, expired products, or your products.
again, you know what, when you do your cost of goods sold calculation, it'll just come within the calculation, because you'll count, it won't be, don't include it in your count at the end of the year. That's how you would do it. Don't include it in your ending inventory for anything that's expired, and it'll come out as a cost. It's a separate expense. It's gonna be on Schedule C as a separate line item, as far as cost of goods sold where it's reported. Yes, so when you have an expired product, you're not gonna include it in your inventory at the end of the year. And so when you don't include it, it will come out as an expense based on this calculation.
When you sell, when you mentioned that, you have some personal use, can you just sell it to yourself and keep that instead, or are they looking for personal use in your entity?
You could probably, the question is if, you know, what's the requirements for personal use as far as reporting? You can really do it however way you wish, but if you just take it out of the calculation, you're gonna be doing it at wholesale. So I don't know that you'd wanna sell it to yourself, because you don't wanna pay sales tax and everything. You already paid, you know, so I'm saying. Just keep, yeah, just document it as personal with that amount coming out at wholesale. Okay.
One more question about personal use.
Yes.
So do I get to deduct all my personal use?
Well, you should deduct all your personal use, but it's not an expense on your Schedule C, because you're saying, I'm taking that product for me, not for anything to do with my Mary Kay business. It's not a deduction, correct.
Because you've already taken it off your shelf, so it's in the calculation. So you're not paying tax on it, but because if you're doing it in the calculation and taking it off your shelf, then that's kind of already the deduction, because you've taken it off your shelf.
Right, so what we wanna do is we wanna say, I've taken this for my own personal use, therefore it's not a deduction, and so that's why it's part of this calculation, and it will automatically not include it as a cost of goods sold. Yeah.
But wouldn't personal use stuff be considered advertising?
You know what, you're gonna have a hard time with that. So the question is personal use considered advertising? And you're really gonna have a hard time defending that with the IRS. Because they're gonna ask you, okay, would you never wear makeup then?
Me, personally, probably no.
You'd have a hard time defending that, just like, you know, like uniforms. Uniforms have to be something that's only a uniform, something that you never use and go outside with. You know, I mean, if you just say, hey, my work requires I wear khaki shirts, so what? You can wear those out on a different day. If your requirement is that you have to wear some type of very specific uniform, then that's different. The same thing's gonna be true there with cosmetics. You aren't gonna really be able to make that stick.
I may have missed this, but what did you say about demo products and gifts to people? Where did that come out of?
So when you take your demo products and gifts out of your inventory, when you do your physical count at the end of the year, it won't be there any longer. So it's gonna come out automatically as an expense.
So it's not a separate expense.
No, right, it's not a separate expense, it will come right out of your inventory and that cost of goods sold. So the perfect way to look at it is typically your markup is 50%, right? But maybe at the end of the year, your cost of goods sold is gonna be 55% because you've taken some items out that were used for other purposes, not just product sales. So if you follow the formula, it will work, it will come out. The key is, of course, you have to take a physical inventory. So just use your sheets at the end of the year and do it at wholesale, and you'll be fine. Okay? All right. How are we doing at time?
You're doing good,
Okay,
ma'am.
good,
You're doing
okay.
good.
Yes.
Limited editions, do you see those in your inventory, or you break them up at a certain point in time?
So you're saying that you probably, so the question is what about limited editions? You can't sell them any longer really because they're, okay, so again, if you're taking them out of inventory because we can't sell them anymore, then that's what you would do, you would take them out and then they become an expense. Same thing as the expired, anything that's expired, you're taking it out of your inventory, it automatically becomes an expense. You know, and a thought item is maybe in some of those items, you know, you might wanna think about giving them to a charity. There are wings, shelters that will accept those types of donations, and, you know, that might be an option as well. Okay, so now, the next item we're gonna talk about is self-employment tax. Okay, so, This is gonna be on page 12, there's a form on that that kind of shows you the self-employment tax amount.
Right.
When you're an employee, your employer takes out every week out of your paycheck, federal, state, FICA, and Medicare. So now you're self-employed, you have none of those coming out. At the end of the year, the IRS requires you to pay FICA and Medicare expenses. So this form helps you calculate it. It's only on the net of what you earn, not the gross, it's the net. And the calculation is 15.3% of what your net is, and then you do get an offsetting deduction on your page 1040, page 1. So you're gonna get a little bit of a write-off on the front page for that as well. Now, the reason that you're doing this, sorry? Yes. So on your net income that you'll calculate off of Schedule C, you're going to pay 15.3% of that as self-employment tax. This is an added tax on to what your other tax return is already calculated. It's an additional tax. And then you'll get a write-off on page 1 of your 1040 for 1/2 of that amount. So it's a deduction on your page 1. One more time. So on your Schedule SE, you're gonna be reporting 15.3% of your net income is subject to that tax. And that amount is added on after you've already completed your tax return for your other items. You know, you're taking out your Schedule A for real estate taxes, mortgage interest, all of that. So after that, it's an additional tax that's added on. And then the IRS allows you to take 1/2 of that as a deduction on page 1 of your 1040. So you're getting some relief. Typically, if you're working for someone else, you get a W-2, you pay 1/2, your employer pays 1/2. When you're self-employed, you're considered an employer and an employee, so you must pay both. But just like the employer who gets a deduction for the portion they pay for you, on that page 1 of your 1040, you're gonna get a deduction, because you're the employer. So that's how they work it. They just make it a little bit more cumbersome. It's the IRS, you know. I mean, so that's how we're gonna have to work in their forms, but that's how it's calculated. Okay? Now, remember too, that what you have as self-employed earnings also counts towards your Social Security benefits. Those are considered wages, just as a regular W-2 would be. They count towards your quarters in earning the benefits. Okay? Any other questions on that? No? Okay. All right, so another item that you might have would be child care expenses, and that's on page 13. So if you have children.
Roger's talk, you probably have about 5 minutes.
Okay, thank you. So if you have someone who cares for your child or children while you are working, you have the possibility of getting a write-off on the child care deduction. Okay, you must report who provided those services and the amount of those services, but you can get a write-off for those amounts that you paid to a caregiver while you were working. So, yes?
Like, my daughter family watches her, and I still have to pay them, but there's no, like, contract written up for that, so how does that work?
So, if it's a family member who's paying for those services, if you report them as earning income on this schedule, then you can take it as a write-off. If you don't report them, you can't take it as a write-off.
But if I report them as earning income, then she'd have to...
Yes.
Okay.
Exactly. So, very briefly on this form, it's $3,000 per child that you can claim as the expense, up to $6,000 for the year, and then you get a credit depending on what your income level is. So we'll just,
Is there a certain threshold, like you have to have paid at least this amount to even make this worth it?
no, you could go to like from, $10. I mean, you'll still get something,
Okay.
because it's a credit. Okay, so the last item that we'll just kind of briefly talk about is estimated tax payments. So we touched on this a little bit when we talked about the self-employment income. When you have a regular job, you're gonna have federal and state taxes that are gonna be withdrawn.
What if your child is in preschool or something? Does that count?
If you're working during that time, yes.
Okay. Oh, what's the question?
Sorry, your child's in preschool, does that count? And I said, if you're working during that time, then I would say yes. So, estimated taxes. If you have a job, your employer's taking out federal, state, FICA, Medicare. That doesn't happen when you're self-employed. So, once you start to have more income, you may need to pay estimated tax payments. So instead of paying every week as you do with the job, you're gonna pay quarterly to the IRS. Now, the IRS doesn't know how much you should pay. They don't mandate how much you should pay. It's really the burden's on you as a taxpayer to make those payments. Could you make one and not the next one? Of course, they don't know. They just collect the amount and they look at it as your payments coming in. Estimated tax payments are again quarterly, but being the IRS, they really aren't quarterly. They're paid April, June, September, and January. And it's due by the 15th day of those months. And it's important that you actually make them, postmark them by those days, because if you're late, then you could be subject to underpayment penalties. So once you get to a point where you're making more money and you find that when you're doing your schedule at the end of the year, your Schedule SE and your Schedule 1040, that you're paying too much, you might be penalized for being considered underpaid. So you want to make those payments during the year. The payments are typically calculated based on the previous year. So 2014 is going to be the calculation that I use to make my first estimated payment April 15th of 2015. So again, there's no mandated amount. It's up to you as a taxpayer to determine how much needs to be paid.
I started in December of 2014, so should I be concerned about estimated
No. Right.
for next year?
You might next year. Right.
When I'm making $1 billion.
When you're making $1 billion, then you might want to estimate it. So I'm going to wrap it up so we can give Roger some time to talk to you about pensions, which is another expense that you are all entitled to as self-employed individuals. And, you know, my takeaway from here is organization is important. Keep track of your receipts. A lot of us, you know, say, oh, I'm paid, you know, a couple dollars here and there, and you don't keep track of those receipts. Take everything that you're entitled to. The government allows these expenses. Take advantage of them. You know what, again, if you want to give me a call, I'd be happy to speak with any of you. If you just have a question, something that popped up in your mind after we're done here, you just want to say, hey Pam, what about this? I'd be happy to answer those questions. You can email me, give me a phone call, whatever. Great, thank you very much.